Hello and welcome to Cloud9Fin. My name is Max Frumes, and I'm the global head of distress and restructuring at 9Fin. I'm joined today by Emmet McNally, our head analyst over in Europe on distressed credit. Emmet, welcome and thanks for joining us.
Hi, Max. I'm glad to be here.
And I'm glad to be here, join you in sunny London this week.
Sunny London, absolutely.
Even though I'm in the office and Emmet's joining us from home right now. Well, we're here to talk about one of these perpetually distressed European credits, Ardagh. And Ardagh it's a packaging company, and it's got a lot of different shoots and entities. Right now it's currently broken down into a metals business and a glass business. But Emmet, could you just give us a brief summary of what restructuring is Ardagh undergoing presently?
Yeah, absolutely. So, like you said, the way to think about Ardagh, at least the way I think about it, is there's a glass business and a metal business. And something that's really important to say from the outset is there's no direct impact on the metal cans business. This is related to the glass bottles business. The metal cans business is a separate listed entity on New York Stock Exchange. The glass business is the privately held company that is subject to this restructuring. So what we've known for some time now is that the glass business is over-levered. And so it was going to need to come up with some kind of restructuring deal. Last year, the company put in place sort of a stopgap with this double dip, which we might get into later. But now, more recently, the company has cleansed creditors that were party to the restructuring negotiations, whereby the company put forward a proposal, and then a group of unsecured bondholders counter-proposed that because, I guess, for some reason, they weren't happy with the company proposal. Broadly speaking, under both deals, the company's proposal and the unsecured's proposal, the majority of the unsecured bond debt is equitized. And then there's a large chunk of secured bonds as well. In the company's proposal, they were kept whole and par reinstated into two separate entities. And in the unsecured proposal, they equitized something like 23% of the principal. And
like, Ardagh is this right now, there's no deal. Right. And this is one of these very interesting situations that has really been part of this recent trend in European, like major European structures, including Altis, where there's a larger element of the liability management exercises and all the technology that those have entailed, including cooperation agreements among creditors, the shifting of assets from one entity to another away from certain creditor groups, the bringing in of third parties such as Apollo to provide, outside financing, to basically threaten the existing creditors with subordination and so this is one of those deals that doesn't have a resolution just yet, but it has a lot of moving parts, and it's kind of an interesting case because it's really been a mess for years and years. The company has restructured several times. Can you just briefly go back to when was the company all together? At both the metals and the glass business, and then what happened from there?
Yeah, so I think it's important to just touch on first. It's a global conglomerate, and it's a mix of glass bottles that are used for beverages and metal cans as well. They're also used for beverages. It was founded and sort of built up by a guy called Paul Coulson. Started out in the UK and Ireland, and then over time grew and diversified into the US and so on. And then, like you were saying, Max, before it was broken down into sort of different parts. It was, shall we call it, the legacy Ardagh group. In 2019, that was the first noticeable transaction where it carved out one of its subsidiaries. It was its specialty metal cans and food business. That became a company called Trivium, which is also a leverage finance issuer. That was a joint venture between Ardagh Group and another smaller entity called XL Holdings, which was an OTTP, Ontario Teacher Pensions Plan, group portfolio company. there's nothing necessarily overly controversial about the Trivium carve-out because it was done and the cash from the transaction was steered towards paying down debt. The only possibly contentious part about the deal is the fact that Trivium is held as a joint venture equity stake in the Ardagh Glass restricted group, but it may fall under the definition of permitted joint venture, which would preclude it from the asset sale covenant. So were Ardagh to sell the Trivium stake, there's a question mark about whether or not it would have to use the proceeds per the asset sale covenant. So if it didn't, obviously that's bad news for creditors. If it did, it's a better protection for creditors. So nothing overly controversial about Trivium. And then the more recent and the more contentious transaction is in 2021, when Ardagh carved out its metal cans business, Ardagh Metal Packaging. It did that in a kind of a convoluted way with this SPAC partnership with an entity called Gores Holdings. But ultimately what happened was Ardagh carved out its glass business, listed 24% of the equity on the New York Stock Exchange, and then the remaining 76% stake it put in an unrestricted entity outside of the Ardagh glass business.
Right, and like this was from the creditor's estimation, right? Now the bulk of the credit of the over-levered entity exists at the Ardagh glass business. Is that right?
Yeah. And I think that it's been the case for many years that the metal cans business is much more valuable than the glass business. You know, if you look at trading multiples for glass bottle companies versus metal cans businesses, it's a 3 or 4 turn of difference between where they trade. There's been a lot of equity value in Ardagh Metal from before it was carved out right up until now, whereas you could argue that the glass business was left over-levered in favor of returning dividends and capital to shareholders through that Ardagh glass transaction. The Ardagh Metal transaction.
And as part of this history leads us up towards today, right, where you have the unsecured glass creditors that are being deeply discounted and distressed in both the proposal just in the market in general. To the extent that and you've done a great job at your piece today that came out today. It was called A Closer Look at the Ardagh Restructuring Proposals, about these counter proposals between the company and the senior unsecured note holders. Can you break down how much value has been moved away from the Ardagh glass creditors in the most recent asset transfers from your calculation or your estimation?
So this is high level, but so Ardagh Glass or Ardagh Group received $3.4 billion in cash from the carve-out of Ardagh Metal Packaging, of which around $1 billion or 30% of the $3.4 billion was steered away from the Ardagh Glass creditors. It was dividended up to an entity above Ardagh Group, which is an issuer of PIK notes. There was $448.6 million of that cash used to voluntarily redeem the Ardagh Finance PIK toggle notes at a premium of 104, and then the remaining, so a little over $500 million, was dividended out as dividends to Paul Poulsen and other shareholders. So the way that was structured was Ardagh Group paid 2 special dividends up to an entity above Ardagh Group, which was then partly used to repay the PIK notes and partly used to pay dividends to shareholders. I should also note as well, the shareholders to Ardagh Group as a whole were also, and I believe continue to be, holders of the Holdco PIKs. It's never been formally disclosed what proportion of the Holdco PIKs shareholders as a collective owned. The latest information we have is that Paul Poulsen, who's the founder and majority shareholder, he sold down 25% of his PIK holding notes in 2023, and that reduced his nominal principal holdings to between $42 and $43 million.
Yeah, and these are also PIKs that are targets of this Apollo hunter-gatherer financing that has yet to be used. Can you just explain the partial solution that was implemented last year when Apollo came in as a third-party lender?
You talked about an example of an LME. I think some of what was complicated about this this structure in this deal is actually being unwound now. But like I said, there was a stopgap put in last year. So Ardagh Glass had 2025 secured notes coming up for maturity that it couldn't refinance. So rather than doing a full-blown restructuring of the cap stack at the time, it used the unrestricted entity holding the Ardagh metal stake to raise financing. So it raised an initial term loan from Apollo, which was a new creditor to the company, secured against the 76% stake in Ardagh Metal Packaging. That was on lent to the Ardagh Glass Group, creating a double dip where Apollo would have a claim against the entity holding the Ardagh Metal stake and also a pari passu claim with the secured creditors to the Ardagh Glass company. And then, Max, like you said, there was a hunter-gatherer quote-unquote strategy implemented as well, or a transaction as well. That was where Apollo was committed a 250 million facility to the entity holding the Ardagh Metal stake, which it could use to go and buy either the unsecured bonds in the Ardagh Glass business or the PIK notes up above Ardagh Group, and then exchange those instruments into the entity holding the Ardagh Metal stake at purchase price plus some sort of undisclosed premium. To date, that facility has not been used, and actually now, as part of the restructuring proposal put forward by the company and the unsecureds, the Apollo loan is being repaid by new money being backstopped by either the secured creditors or the unsecured creditors, or a mix of both.
Yeah, and effectively, a lot of the notes that were targeted for that facility were locked up in co-op agreements.
Yes, that's right, and also I think it would have been difficult to justify, possibly buying the PIK notes at whatever cash price they were at or market price they were at the time, because now the PIK notes are basically being zeroed. And, there could have been an argument where value was being sort of further steered away from the Ardagh Glass Group because the PIK notes don't, they're not issued out, but the Ardagh Glass restricted entity, they're issued in the whole above the structure.
And so this deal didn't go through. They hit a gap. What's the bid-ask spread between the Sun's proposal and the company's proposal?
So one of the big differences between the company proposal and the Sun proposal is the treatment of the secured bonds. In the company proposal, they were par reinstated into debt, whereas in the unsecured proposal, they're partly equitized. The preference equity that they would be offered in the unsecured proposal, it pays them 9.25% annual dividends. So it's a pretty decent return on capital. And also the collateralization for the preference equity is the stake in Ardagh Metal Packaging. It's a 76% stake. So, it's not apples for apples in terms of how they're treated, but I don't think the bid-ask spread there is all that wide. And I would expect the middle ground to be found there. I mean, maybe possibly a little bit steered more towards the unsecured proposal. The other big sort of difference with the bid-ask spread, like you said, is just the ultimate cost of capital of the reinstated debt at both the Ardagh Metal entity and also Ardagh Glass. Again, I think servicing is kind of feasible in both proposals. The challenge in cap structure to service post-restructuring is the Ardagh Glass business. In either proposal, it looks challenged, but that being said, there's plenty of liquidity to cushion any sort of shortcomings in servicing capacity. And then I think, aside from the bid-ask spread between the two proposals, another possible kind of factor here is the fact that Arini and Canyon have litigated the company. So yeah, they come
out of it, and they're with separate interests, right? Because they even if the company gave the Suns everything that they wanted, Arini and Canyon would not have and be happy. Yeah. They take issue with the amount of equity that would be retained by the certain shareholders, among other things. And I think the underlying argument is the amount of value that they feel has already been siphoned away from the glass creditors. Yeah, exactly. Right. So, and what now? And they just filed suit after the disclosure of the negotiations. What are they proposing happens?
I mean, that's less clear cut than what they're arguing has been the problem. And like you said, it's not just arguing that there's further value steered away from these creditor claims. Now they take it right back to that 2021 deal and allege that the 21 deal contravened the terms of the bonds at the time. And so I think, the history is important here, because this isn't just a restructuring happening in isolation now. I think actually, if you really zoom out a little bit, Ardagh is probably an example of one of the earliest European LMEs we saw. Carving out the Ardagh glass business was it was a contentious thing to do. It steered value away from creditors, and it used loose documentation. So the interesting thing with the Arini and Canyon litigation is that they hold a series of notes. They hold over 50% of a series of unsecured notes that had the tightest covenant package before the Ardagh glass carve-out was done. Ardagh in 2020, before they did the Ardagh metal carve-out, launched a concept.
And this is specifically these the sterling notes, the 4 3/4 sterling notes issued out of the Luxembourg entity.
Exactly. They're one of the oldest bonds left in the cap stack. They were issued 2017, and then amended in 2020 to loosen the restrictions so that they matched the rest of the cap stack. Now, it's not clear whether or not that was needed to do the Ardagh metal carve-out or not, but this sort of series of events makes it look that way.
And that's really interesting the way you put that. This was an LME before it had a name.
Exactly.
And mostly accomplished out of court.
Yes. Entirely right. Out of court. So that the Ardagh glass transaction was done out of court. The Apollo double dip transaction last year was out of court. Thus far, there's no implementation of this through the courts. Like you said, the deal hasn't been reached yet. I mean, another interesting component here is the counter proposal put forward by the Unsecured group. There's a question mark there about implementation of that, because they talk about, they infer that there could be stubs of the secured bonds and the unsecured bonds left behind for non-participation. But the structure of the deal they're proposing is such that it looks like it would require over 90% consent, over 90% participation. And as you'll know, in any deal where there's over 90% participation, generally speaking, you can drag along or cram down the non-participants. So there's a bit of a question mark over whether or not the unsecured proposal would be implementable. But the reality is they're going to have to go back to the restructuring table in any case, and I guess hammer out some final terms and find a middle ground. And I think if they get a critical mass on board of the secureds and unsecureds, the likelihood here is they get a deal done, possibly in court, and if not, they'll get it done out of court.
Yeah, I appreciate the closing of your article today. That, hey, look, this lawsuit could just be a speed bump one way or another. It's going to benefit everybody to get some sort of deal done. We'll see what that looks like, and we'll be covering it all at 9fin. Emmet, thank you so much for your astute analysis as always, and your commentary today on the Ardagh situation. And thank you everyone for listening.